fiscal policy is driving a little bit more of markets. And what I mean, the bond market, which is typically 3 to 4 times larger than equity markets, or is monetary policy as effective as it used to be, if we look over the last 40 or 50 years?
I think monetary policy was a really big driver of market action over the course of 22, 23, and to some extent in 24. And that's really, on a forward-looking basis, taking a backseat. And this is true in the U.S. context, actually also true across basically all developed world economies, where the macroeconomic data essentially is handcuffing all these central banks from meaningfully moving policy easier or tighter at this point. And so if you look at something like the Fed, the unemployment rate, which of course is what they're focused on, the core PCE rate and the unemployment rate. The unemployment rate, there's a little bit of a scare last year, but has actually ticked down. It's stabilized. And if anything, the low immigration environment is likely to keep the unemployment rate relatively contained. It will not likely rise nearly as fast. In fact, nearly all the rise in the unemployment rate that we saw before was a function of lower skilled labor markets loosening as a function of immigration. And so that's stabilized. And so even if growth slows, the unemployment rate may not rise nearly as fast. And so the Fed may not feel an urgency to ease in response to that. And that's coupled with the fact that core PCE inflation, basically, it hasn't changed in 2 years. And the most recent numbers are not, actually are at the higher end of that range of the last couple of years. And so you put that together with the risk of inflationary policy from something like tariff increases, and the Fed is going to sit there and say, maybe we're not going to be proactively easing in this environment, like I think many people had expected as of last year.